So as I said, my name is Chad Caffer. I'm with a law firm called Davidson & Caffer. I know some of you have seen me speak before. Davidson & Caffer has been in the Valley, or at least the Davidson law firm has been in the Valley for 26 years. I've been practicing for 13 years. Our firm handles litigation as well as transactional work, which makes us a little different from a lot of law firms. Most law firms have a transactional department and a litigation department. We believe that if you don't put deals together, you don't understand them when they fall apart, and can't defend your clients properly in court, and if you've never seen a deal fall apart, you don't understand how to properly put one together to protect your clients. So we do about 50-50. Our clients range from anything like people who are selling medical products or businesses like that, landlords, people who are purchasing property for the purpose of developing it. We represent some golf developers, and it's pretty much soup to nuts. Particularly with real estate, we will handle everything from entitlements work, construction contracts, zoning, as well as any litigation involved. And then with regard to businesses, we do lots of different entity formations and a lot of service-based contracts and a little bit of employment law. So it's anything that you can do with a business or with a piece of real estate. That's really what we do. Today what we're going to be talking about is about entity formation and using entities to protect your personal assets. Let me see. So here's what we're talking about in essence, is using entities for property investors. Do we have anyone here who is not a United States citizen? And do we have anyone here who occasionally invests with people who are not United States citizens? Okay, so some of this is going to be not necessarily germane to what you're doing, but if you're purchasing property in Arizona, some of it will still be. We have a lot of particularly Canadian investors in the Arizona market. Arizona is one of a few states in the United States that will allow an entity type called a limited liability limited partnership. It has certain tax advantages to it, so a lot of Canadian investors come to Arizona to set up their entities, even if they're investing in Georgia, Florida, somewhere like that. So let's talk about the entities. First of all, why use an entity as a property investor? Well, the first is asset protection, and what we mean is you're essentially separating yourself and your investment from your personal assets. So if someone goes to sue, they sue the entity, it's the entity's assets, which is essentially just the real property that you purchased, that's at risk, and not your personal assets like your bank account, your car, things like that. Tax advantages. Now this depends on a lot of different things. When it comes to the entity type that you're using, there are lots of decisions that you can make, particularly with a limited liability company, that can affect your ultimate tax basis. For instance, if you decide that this is something that is absolutely for you, one of the things that you can do is set up your LLC as a company that makes an S corporate election or an S election, which means it's being taxed as a corporation. It has certain write-offs it can do, but in addition there are things that you can do with regard to personal tax planning, like setting up solo retirement accounts. The basis with regard to retirement accounts, some of you might know you can put in about $17,000 right now in a 401k. If you own a business yourself that's wholly owned by you, you can put, I believe it's just been moved up to $26,000, but the business can match 100% of that. Meaning that unlike other people who are setting up retirement accounts, you have the potential to put away $52,000 tax-free. That can create some significant tax savings if it's done properly. And how do we do this? We have what's called entity personhood. This is a little bit of a difficult legal concept to get your head around, but the idea is that the law will treat an entity as its own person, separate from yourself, depending particularly on the type of entity. But what we're really going to be focusing on here, particularly for domestic investors, is limited liability companies. So the law will treat that entity as if it was its own person, with its own responsibilities and liabilities, separate from you. So when the entity acts, provided it follows certain rules, it's the entity that's liable for the debts and not you personally. So if there's ever a lawsuit, the lawsuit goes against the entity. Oop. I think I hit the wrong button here. Oh, there we go. Okay. Here are the types of entities. And these are used for different reasons, and some of them used more readily than others. There's a C corporation, which everybody is pretty familiar with. For instance, your Apple is going to be a C corporation. The C corporation has some advantages to it, and for property investors, this is one of the least likely forms that you would use. But the advantages are that it has liability protection, and anybody can invest in a C corporation. They essentially buy stock. Now, the disadvantages are the possibility for double taxation, which means a C corporation pays taxes on its earnings, pays dividends out to its investors, and then those investors pay on those dividends as well. Also has what we call unwieldy norms, which means that it's just a fancy way of saying that in order for the corporation to do anything, it has to go through a very particular process. You have to properly call a meeting, you have to make sure that there's a quorum, you have to get a vote, you have to document that, and if you don't, there's a potential that you'll lose some of that liability protection. And there are disclosure obligations that are much stronger. Now, we have dealt with some of this at my firm, but typically the disclosure obligations are the sorts of disclosures you would make either in a private placement memorandum or within a public offering. I'm sure you're all familiar with IPOs or a public offering. If you've got a 401k or anything like that, or you've ever purchased stock or heard of someone who's done it, there are disclosures that are required about who the principals are and all these other sorts of things, and what the risks of the investment are. So the C corporation is something that you can use, but it's very rarely used unless there's a tax reason for doing it. For instance, sometimes people will gain a tax advantage by having a partnership. In order to have a partnership, you need to have a partner. So typically what we'll do is have that person own 100% of a corporation and then partner with the corporation individually. So they essentially own a company that they're partners with. It sounds very complicated, but there are reasons for doing it, particularly with foreign investors. The next is an S corporation. The S corporation has some advantages. There's the liability protection, and there's what we call flow-through taxation. And I'm giving you this sort of as a background for the limited liability company, really. But the S corporation, when we talk about flow-through taxation, what we mean is the corporation doesn't pay taxes on its earnings. It pays out its dividends to its shareholders, and then the shareholders pay on those earnings, which means that you're not subject to the double taxation of a C corporation. And the disadvantages: when you have an S election, only U.S. resident natural persons can be investors. So what that means is I can't have another LLC invest and buy stock. I have to have only people, and all of those people all have to be U.S. citizens. And then you have the same sort of norms where you have to notice meetings and take down notes and things like that, as well as disclosure obligations. This brings us to the limited liability company. Now, for a real estate investor, this is really going to be the most common form of entity that you're going to see. A limited liability company is essentially, it's kind of like a corporation or a hybrid between a corporation and a partnership. It's created in most states, and Arizona is one of them, pursuant to partnership statutes. So it has very loose norms, which means that in essence it can just act. I mean, provided you've got somebody designated to sign things, either as a member or a manager, it can do whatever it wants to do. You don't have to notice up meetings, you don't have to take special votes, you don't have to take down minutes and things like that. It has also the advantage of having a lot of different ways that it can be taxed, and one of those is to make this same S election, meaning that the earnings of the LLC flow straight through to the members. So the members don't have to deal with the double taxation where the LLC is paying taxes and then the members are paying taxes as well. So there's a lot of good things about the limited liability company. One of the only bad things is if you're dealing with Canadian investors, it is subject to a double taxation. So when it comes to Canadian investors will get their money through like anyone else would. They'll file their taxes in the States for their earnings. Here, I can move that out of your way, sir. So they'll file their taxes in the States, they'll pay their personal income tax on those earnings, and then when they go to Canada, they'll pay taxes a second time on that same money. So that's a disadvantage for limited liability companies. Now the way that we get around this with regard to foreign investors is with limited liability limited partnerships. This is essentially a partnership. Has everybody ever heard of a limited partnership or a limited liability partnership? Well, here's what a limited partnership is in essence, or a limited liability partnership. With a limited liability partnership, limited partners are liable up to the value of their investment. So if I kick in $10,000 as a limited partner, the partnership gets sued, the most you can get out of me is the $10,000. General partners in a limited liability partnership are personally liable for the debts of the partnership. So if I get $1 million judgment, I can, and the partnership only has, $100,000 worth of assets, I can go after the general partner for the remainder of the judgment. Here's where a limited liability limited partnership, or what we call a triple LP, is different. It makes an election to limit its liability to the assets of the partnership, if that makes any sense. So the idea is, if the partnership owns, same deal, the partnership owns $100,000 worth of real estate, and that's all of its assets. someone gets $1 million judgment, they sue the partnership, they get their judgment, they go after it, and they get that $100,000 worth of assets, that's where it stops. You can't go after the general partner. This was used for a very long time with regard to Canadians. Now, well, I say a very long time, it's really about 10 years that people have been using it because it's a very new entity type. It's very similar to a limited liability company, but at least with the way that it's taxed like a partnership, so the money flows through directly to the investor pays individual income tax. When it comes to Canada, Canada has always recognized this as a way to avoid double taxation. I will tell you that recently, about 2 months ago, there was an individual from Canada's taxing authority, the CRA, which is basically our version of the IRS, who had said that there was a possibility that they were going to disallow this entity type. So we're all kind of scrambling to see what we do with that. And I know I'm throwing a lot of information very, very quickly at you. So if anyone has any questions while I'm describing this, please feel free to ask. So when we talk about following corporate norms, what does that mean? It means a lot of different things. First of all, there's, and I want to just sort of preface this by saying, I'm sure that everyone here has known somebody who set up their own LLC, and they say this is incredibly easy, or set up their own company. It's incredibly easy to do, right? And what people normally have the ability to do is this first step, filing organizational documents. Now, here's what I want to impress upon you. When you're setting up a company, the reason you're setting up the company is twofold. One is to get tax advantages, and one is to get liability advantages. If you mess that up, you'll lose the tax advantages, or you could potentially lose the liability advantages. So the issue is, a lot of people think that what they're doing is they're setting up a company to create legitimacy to their business. You know, they're looking at it from the standpoint of, now the general public sees me as being legitimate, but that's not really the reason you set up a company. You set up a company for that liability protection. So when we talk about filing organizational documents, if you've ever set up an LLC, the organizational documents are articles of organization. The corporation, it's articles of incorporation or a partnership, a certificate of partnership. This, I can teach anyone to do. You can be 12 years old and I can teach you how to fill out LLC's articles of organization. It's a very, very simple one-page form, and it's a very inexpensive filing. This will get you started, but it doesn't get you what you need in terms of liability protection. That's where part 2 comes around, and 3 and 4 for that matter. Part 2 is establishing governing documents. So remember that when I said originally that what a company is essentially is it's its own person, separate from yourself. There are ways to invalidate the courts or people seeing that as being separate from yourself. One of the ways that that happens is commingling funds. I'm sure you've all heard of the term commingling funds and probably wondered what it meant. It means instead of opening up a company bank account, I keep my personal checking account, and when company checks come in, I deposit them into my personal bank account. Well, I've now commingled assets. Another way is to essentially do what's called, essentially what it is to act as though you and the company were one and the same. They call it the alter ego, or an alter ego of myself. The way that you get away from someone claiming, this is your alter ego, I should be able to just sue you personally, and as an attorney, believe me, I do this, is to have governing documents. Now with an LLC, that governing document is an operating agreement. With a corporation, it's establishing bylaws. And with a partnership, it's a partnership agreement. And essentially what it is it's a document that says this is how we'll run our company. And provided you follow that format, it's very, very hard for an attorney to say you are the alter ego of your company. And this is the case, and I know a lot of people go to investor seminars and they're told, well, if it's a single member LLC, if you're the only one who owns it, you don't need this sort of thing. That is not true. Even when I set up a single member LLC, I always have clients sign an agreement with themselves about how the company will govern itself. Because at some point, if you get involved in litigation, someone like me will want to see that agreement. And if you don't have it, that's one step forward toward suing you individually. And I should give you sort of a background when we talk about liability protection. You know, every single time that someone walks into my office and says, can I sue this person for this reason? 100 times out of 100, the answer is yes, you can sue this person for this reason. That's not the analysis that attorneys do. What attorneys do in terms of an analysis is there a reasonable defense to that lawsuit that will make it so that I don't want to sue them? What you're doing by establishing these governing documents is creating part of that reasonable defense so that attorneys wouldn't want to sue you personally, so that someone who's coming after you won't want to sue you personally. Because if I say, look, this is not me, this is the LLC acting, I keep separate bank accounts, I have an operating agreement, I've established the company with the state that it's operating in. If I do those sorts of things, by statute, by law, there's an assumption that there's a distinction between myself and the LLC, and your remedies are limited to the LLC. The third thing, and this sometimes doesn't happen, but it's and it always should, it's to capitalize the company. Now, part of doing that is pulling a tax ID number or an EIN, an employer identification number, essentially the same thing, and opening a bank account. So the company needs to have its own bank account. So if you're purchasing, for instance, rental real estate, rents should come in to a company bank account, and then from that operating account, the actual dividends that you're paying yourself, or the actual distributions or draws or salary, or however you're doing it, should come out of that account and then be paid to you. It should not go into your personal account. Finally, appointing a resident statutory agent. Now, this is something where a lot of people really have some issues, and I know that we were discussing this a little bit before we started. People will set up their company, and they might even get this step right, and they might even get this step right, but a lot of times what they do is they name themselves as a statutory agent. So I'm my own agent for service of process. And what that means is, if someone ever wants to sue you, that's the person who a process server can go to and serve on behalf of the company. Here's the problem. If you name yourself as the statutory agent, and let's say, for instance, you go on vacation for a week, process server makes 2 attempts at your house, they can't find you in 48 hours, and they go back and they say, we tried and we can't find them. By law, one of the ways that they can serve you is by taking that complaint, taking it down to the Corporation Commission, and just leaving it there for 40 days. If it stays there for 40 days and you don't claim it, you're deemed served. I'm an attorney who's been practicing corporate law for 13 years. I've been to the Corporation Commission probably 30 times. I don't show up every 40 days and make sure there's not a complaint there. So my guess is if you own an LLC, you don't either. This happens on a fairly regular basis where someone gets a judgment against them that's a default judgment without knowing about it. I had a client, for instance, it was a company out of Canada. They did not maintain a current statutory agent, and as a result, they were served at the Secretary of State in that instance because it was a partnership. So they were served at the Secretary of State, the complaint stayed there for 40 days, judgment was entered against them, and they lost the property. We had to come back and fight that. That took almost 2 years to get this property back. The way that the property was taken from them, someone bought a tax lien for, I believe, $600. The property was worth $860,000, which is not a bad return on investment, just because you didn't have a statutory agent. Now, here's why I say use an attorney. There's 2 big reasons. Reason number 1, a process server can never say that they can't find me. I'm registered with the State Bar of Arizona. If I'm not there that week, I'll be there the next week, or somebody can tell them. Number 2, other attorneys are required under our ethical rules to give me extensions. So you have 20 days to respond to a lawsuit. If I call that attorney and say, I need a little more time, I'm trying to locate my client, ethically, he or she is required to give me that additional time. They don't have to do that for you. I mean, technically they should. It's probably the right thing to do, but most people don't even know what to do when they get a lawsuit. You've got 20 days to respond, and now you're going to spend the first portion of that time trying to find an attorney who you think can issue a proper response on your behalf. That is not a position that you want to be in. Now, we're going to talk about separating your assets a little bit. This is basically the sort of don't carry all your eggs in one basket principle. It's pretty straightforward, but here's the idea. Normally, whenever people purchase real property, and particularly when what you're doing is doing something like either, well, really, when what you're doing is buy and holds, this is extremely effective, and even if you're doing a couple of fix and flips, it's the sort of thing that you typically want to do. The idea is this. We set up a parent company, LLC, so let's just call it Real Estate Investment LLC for ease of use. That parent company then owns 100% of the membership interests in a subsidiary LLC, subsidiary LLC, subsidiary LLC, so on and so forth. each one holds a property. Now here's the reason why we do this. If somebody slips and falls on a property owned by subsidiary 3, they sue subsidiary 3. But they can't sue subsidiary 2, subsidiary 1, or the parent, meaning that this is your only asset that's now at risk. Does that make sense?
So it doesn't have to be a completely separate LLC?
It does have to be a completely separate LLC. So what would happen is we have a parent LLC, real estate investment LLC would be owned, let's say for instance 100% by you. Subsidiary 1, the membership interest of subsidiary 1 would be 100% owned by real estate investment LLC or parent LLC. So this is owned 100% by you, this is owned 100% by this company. And we do that for a couple of reasons. One is to separate out those assets, but the other two, one is frankly a tax savings issue. And sir?
I had a quick tax question.
Sure.
Unofficially, can sub 3 invest in sub 2 to take advantage of certain tax
you can do it.
shelters?
Well, I don't know if tax shelter is the right word. Essentially,
I don't either,
what
but
you can do
Warren
is,
Buffett is doing.
if you want to loan money between the companies,
Right,
provided
right.
it's documented and it's an actual loan, yes, you can do that. So if you, let's say
I
that
don't mean loan. I think that my term was wrong. It's more of an investment.
and you want to know if, well, you want to know if sub 3, for instance, can be a member in sub 2 with the parent LLC. It can do that, but there's a reason not to, and the biggest reason is this. If you set this up this way, and these are solely owned subsidiaries of the parent LLC, you'll only have to file one tax return. So if these are wholly owned entities, and this is true with your own personal taxes, if you own 100% of the parent LLC, these don't have to file tax returns. They'll be what's called a disregarded entity. The tax return will either be filed as a partnership return here or an S-corp return, and then it'll show up on the Schedule C of your tax return. So if you have this company owning this one and this one owning this one, you've now got two partners here. This one has to file a partnership return. So you're just increasing some of your overhead. But if what you wanted to do was to lend money or to get money from this company to this one, you can do it two ways. The most common way would be to pay back, well, the most common way would be to pay the money back to the parent LLC and then have the parent LLC put it in a subsidiary. And the reason that we do that is, particularly if you're making an S election or a partnership election, anytime that you earn money in a scenario that's a pass-through scenario, the IRS will treat it as if you got that money whether you received it or not. It's what we call the phantom income problem. So let's say that parent LLC has a net of 500 grand that year, but you want to leave operating capital in parent LLC of 400 grand, and you're saying this will be great because I'll only pay the taxes on the 100. Wrong. You will actually pay the taxes on the 500 because you've always got access to this money. It's as if it was paid out to you. And they call that the phantom income problem because there's some income that you didn't actually receive, but that you're having to pay on as if you did receive it. And in a certain sense, you actually did receive it because you can always take it out as draws from the company at any time. But that's the basic idea. So there's a tax savings here as well as the liability savings, because if someone slips and falls on this property, they're suing this company and the rest of the assets are all safe. Okay. Does that make sense? Okay. And this is for Canadian investors. Canadian investors are a little bit different. They aren't capable of doing that tiered structure. They used to be up until about 4 years ago, and then the CRA said you can't do this any longer. What we used to do is have a triple LP own a bunch of LLCs that own individual properties. They disallowed that a while back, and at this point now, they just have to use a separate partnership and separate out their assets. Sir, did you have a question?
No.
Oh, sorry. Okay. Yeah, and that's the end of our slideshow. Does anyone have any questions? I know that I threw a lot at you very, very quickly. Yes, sir.
Maybe it's a little silly, but years and years ago, it used to be, Fortune Magazine Incorporated, INC.
Right.
Or, Dave's Dry Cleaners, INC. Mm-hmm. And now you see LLC.
Right.
So, is there a similar designation for an S corporation so that when you're looking at the name, you would know?
No, because really what it is an S tax election. So it's still an LLC. It still operates as an LLC.
But it's just going to say the company name without that extra.
Well, no, because are you talking about? Well, I guess I should. qualify this. When people say S corp, or at least when an attorney says S corp, we mean one of two things. We either mean an actual S corporation, which is going to say Inc. after it, but all of the shareholders are going to be people as opposed to company shareholders, and all be U.S. citizens.
So simply by looking at it, you can't tell.
No, I can't tell if it's a C corp or an S corp. I mean, typically you don't go the C corporation route unless what you're doing is you're soliciting public money, because it wouldn't make sense to do that. When your shareholders and your officers are the same people, and they're taking dividends in a C corp, typically you're paying taxes twice on the same money, so you wouldn't use that. I mean, if you know that it's a small company and it says Inc. after it, it's probably an S corp. The time that you use a C corp is when the shareholders are different than the people who are being paid to run the company. So that's publicly traded companies, Facebook, Apple, things like that.
But so I know this is more about liability, right?
Mm-hmm.
And so in taxation is a whole different realm. But so like a C corp though, you can basically end up with a zero balance at the end of the year, not pay any taxes on it, and you get great benefits from it. And that's good for an emerging or a bigger company that has assets, but a startup is best for an S corp. It is pass through, which includes losses.
Well, it depends. And keep in mind, what I am is a corporate attorney. I'm not a tax attorney. I'm not a CPA. So you want to go to your CPA. But it depends. I mean, for most businesses, really, the LLC is sort of the way to go, because you can make lots of decisions with regard to how you're taxing yourself. If what you're trying to do is to take the company public, what a lot of people do actually is make an S corp election, get the thing built up, and then whenever it gets large enough, make the C corp election and make sure that, or sometimes what you'll do is you'll set up another corporation in some place like Delaware is the most common, because for one thing, you don't have to disclose the shareholders, and for another, it has very tough rules on filing derivative actions, which means it's harder for the shareholders to stop things that you have to do that can be messy when you take a company public. So a lot of times people will either just sell the assets to the C corp, and when they do that, you'll have shareholders who will just cash out and go home, and then you'll have shareholders who will ride that out. And sometimes what they do is just make a conversion, so it just depends. But it really depends on what you're trying to do. I mean, if somebody's running, for instance, an auto detailing shop, that's never going public, and LLC makes more sense. But if what I'm doing is I'm selling some sort of an app that I think everybody's going to want on their iPhone, maybe I'd use an S corp, get some money in, and then later set the thing up as a C corp.
Is there a time limit on when if you declare S, then you can change to C? Is there a time limit?
I don't know the answer to that. I should, but I don't.
And then I was going to hit you the next one, and then can you change back?
No, no. You can change back in very limited circumstances, and normally it's whenever you have a reasonable way to say, we messed up when we made the S election. I've had one instance of that where I had, it's a company that had made an S election, was actually going to a partnership election for an LLC, and they hadn't gotten the consent of all of the members, and one of the members said, I don't want to do this, for a variety of reasons, but it was really to get some capital in. Ma'am?
So the point of having a sub-LLC versus just another LLC entity is what?
Well, there's 2 points of it. One is to decrease the amount of tax filings you have to make. Because if you figure, I mean, your average accountant is going to ask you for, somebody who's not asking a lot is probably looking for $600 for that additional filing. Somebody who's asking a lot might be looking for like $1,200. So you're decreasing your overhead. But additionally, what you're doing is creating an additional layer between you and the investment. So, somebody has to say, okay, well, you messed up at this level, so I get to go after the member, but then the member is just another LLC. Well, did I do things right at that level? And if I did, you can't go after me personally. Does that make sense?
Sure.
Okay. Any other questions?
One more for you. So a single member LLC is not a good way to go for protection. So when you do 2 members, so you add a second person, but you're not going to actually pay them anything. You just need it for your appearance. A
single member LLC can be a very good way to go for protection. I would still do that. And if you don't, so a single member LLC is fine. And provided you follow corporate norms and you set up an operating agreement, separate account, all of those sorts of things. If the issue that people have with single member LLCs is this: if that member ever has a judgment against them, so let's say that single member owns a bunch of real estate, goes out, drives drunk one day and wipes somebody out, gets $1 million judgment against them. one of the things that you can do is get a charging order against the company. If there's a single member, I'm taking that single member's membership interest, so I take over the company and all of its assets. If I've got 2 members, I don't have a right to do that because the other member has an undivided interest in the company. Even if their interest is a 10% interest, it's spread out over essentially the whole pie. So all that I can do is ask for the distributions that would be coming to the member that I got the judgment against. Now, if you want to stop them from getting any type of a paid out